Step two, this is the crux of the business. How does a business make money? What is the revenue model? So you must really look at that number and see what it tells you. So yeah, we've just put a little picture just to give you an example. This was, I think this is Aspen's last reporting annual report. Yeah, you can see that the revenue has grown by 53%. So what is revenue? Revenue is basically sales, because each company, they can be selling a service or they can be selling a product like computers or food or whatever it is. In order for the company to survive and grow and be profitable, it needs to sell what it intends to sell to its relevant customer. So basically, if the sales revenue is growing, like we can see in the example here, 53% revenue growth, it tells you that this company is not growing. It's growing. It's not shrinking. So what you need to be aware of when you're looking at the revenue number is to strip out any distortions to that number. Distortions could come in the form of acquisitions. They could come in the form of asset disposal if there was a business that was sold. So it looks like the company has recorded abnormal earnings, whereas those earnings were only pushed by the sale of that asset. So you must always look out for that thing. So whenever you see a revenue number, you must just check from what was the last previous reporting period's revenue and see at what percentage growth did it rise or fall. And then if it's too high, then you then start questioning if was there any distortion to this number. So that's what I mean there. This will give you a sense of the operational or efficiencies of the company. Obviously, if the company is able to grow its sales, it means that they're doing something right. Operational efficiencies, though, could be impacted by a few things. A company could enter a new geographical area where it increases its market shares, therefore the sales volumes, they go up, or the company could manage their cost pretty well, that the cost line comes down and their revenues increase. So there's different ways that companies try and embark on to manipulate that revenue number to look good. So you as an investor, you always look at results with cynicism, so that you don't get tricked into thinking that the results are great when they're not really great. Again, you will find this information in trading statements or the annual results. All JSE listed companies they are forced to report on the revenue number. Again, another thing that is important when you look at a revenue growth of a company or a decline is by what percentage did it beat inflation, at least, because we know that inflation it determines the value of money over time. So if the revenue beats inflation, it means that the company perhaps has the pricing power, has the ability to pass that inflation to a customer. Therefore, the customers that they're servicing are not price sensitive. They're still willing to buy, even though prices maybe would go higher than inflation. So that means that they're selling a product that's really in demand. So that immediately tells you that you're looking at a good company here. Again, if the opposite happens, then a couple of things that you should get out of that. Could mean that if the revenue doesn't beat inflation, it means that the sales could have dropped perhaps, or the customer might have been price sensitive and switched to a substitute product that is perhaps less cheaper. So again, it goes back to the company on how are they gonna shape their business to sort of avoid price sensitivities of customers and maintain their sales volume. And again, if the revenues has dropped, then it means that market share could be shrinking as well. That also goes back to how the company is shaping and positioning itself out there in the market. What sort of strategies have they got in terms of maybe marketing and then positioning themselves in order to be attractive in the eyes of a customer, because it's a customer that actually increases the revenue line of a business.